Good morning, ladies and gentlemen. Yes, I asked myself, was there any relationship between me and Redwood Financial? But I regret to say they haven't sent me any dividends yet, and they haven't claimed any family relationship whatsoever. They are a very successful group, very pleased to be here talking on their platform today, and very pleased that Charles Stanley has from time to time been able to find business to do that helps them and helps their clients. As Chief Global Strategist at Charles Stanley, it's my task to do the worrying on behalf of some of my colleagues in the firm and on behalf of all our clients. So if people say, well, why are you paid money by Charles Stanley? It's because every day I have to spend a bit of time worrying about whether the markets are going to go up or down and whether our clients as a whole are in the right kind of assets for the conditions which we face in these turbulent, noisy and argumentative markets that keep on moving up and down, but not necessarily in that order. Now, I do have to say to you before I begin that as a regulated investment professional who is licensed to provide advice to people for better or worse, I cannot give you any investment advice today, and this isn't a talk to give you investment advice, because before we give anybody investment advice or sell them some investment advice, we do, of course, need to know much more about your individual circumstances, because what is right for someone with lots of money and happy to lose it occasionally as well as winning it is not the same as someone who doesn't have a lot of money and can't afford to lose any money. So we first of all have to understand what a person is trying to do, how much money they've got, whether they want to make a lot of money, in which case they have to understand they have to take a lot of risks and may wake up one day and discover they've lost quite a lot on the way to trying to make a lot of money, or whether they want to be very, very cautious, in which case they need to understand you won't make nearly as much, but you won't wake up the next morning and discover the stock markets have fallen 5% and you've fallen with them. These have been very good times for those who have been prepared to take a bit of risk. The West had a very bad financial crisis, which you will all remember, in 2008 to 9. The Federal Reserve Board, America's central bank, the Bank of England, our central bank, the European Central Bank, the Bank for the Euro area, all made dreadful banking mistakes. The commercial banks also made quite big mistakes. They got blamed for the whole crisis. But in a way, I think the central banks are even more culpable because what the central banks did, the regulators who were meant to keep the system in good order, they allowed the commercial banks in the first decade of this century to greatly expand their balance sheets, to lend a lot more money to people. And they shared with the commercial banks the idea that because we were now global, to a much greater extent, and because banks had become so huge, it was fine to lend more and more money because it would all even out because everything was so big and it would tend to average. And so the banks built up these enormous loan positions, some of it against houses or businesses that weren't worth as much as they hoped they were going to be worth. But then the central banks decided to make the second, and I think in many ways bigger and worse error. And they decided that it had gone too far, and they decided they wanted to collapse all this extra credit and lending and wanted to bring the banks back down to earth. And boy, did they do that. And most of my fellow commentators and critics of central banks would now agree with the first part of my analysis. Indeed, many of them with me said so at the time, that the central banks were expanding things too much. But fewer are prepared to say with me that the bigger mistake was crashing the banks in the way that they did. There is no need to crash a large, reasonably well-run bank like RBS or the American equivalents. It is the duty of the central bank to provide enough cash, enough money to those clearing banks to keep them going. And of course, because they regulate them, if they're getting a bit worried about the state of their affairs, if they think they're lending too much money to people who won't be able to repay it, they should have private words with them and get it phased down and sorted out over a time period. But instead they decided to do it very publicly, and they actually bankrupted or nearly bankrupted quite a lot of the worst large banks in the system, and that was true of the Fed, it was true of the Bank of England, And it was certainly true of the European Central Bank with some of the Spanish banks and the Italian banks and the Greek banks and so forth. After they'd done enough damage, rather too much damage in my view, they decided to back off. But they then had a problem. They couldn't turn around and suddenly say all these commercial banks that they thought were dangerous were cleared to carry on business as usual. They still kept blaming the clearing banks and said they'd got to keep on reducing the amount they lent to people, and that was going to obviously extend and deepen the recession, because if people can't borrow money to buy a new car, or they can't borrow money on a mortgage to buy their first home, or a business can't borrow extra money to invest in plant or to have a bit more stock, then you have a recession. There has to be a reasonable amount of borrowing in an economy to keep it going and to keep it growing. So the central bank said, well, we can't really backtrack and say these clearing banks are still fine. We're going to carry on bashing them. So I know what we'll do. We'll inject money direct into the economy to replace the money that the clearing banks are not able to make available themselves. So instead of putting the money into the clearing banks to lend it on, they decided to tip it in direct. And these central banks have a wonderful power that you and I would love to have but will never be allowed to have, and that is that if they don't think they have enough money, they just open an account in their own name on a computer and they type in how much money they want. And they can type in big sums. So these central banks, they weren't just typing in a few million, they were typing in tens or hundreds of billions and saying, we're just going to create an extra, in Britain's case, 435 billion pounds of additional money. And we then have that money sitting in our bank account to spend. And it's good money, because everybody trusts the Bank of England. Why wouldn't you? Because they are our money system and they create the pound, and so if they're going to offer you one of their pounds, it's a great pound. It's like anybody else's pound. The fact that it's a new one that they've just created is immaterial. It's a pound. So they had all this money sitting in their bank account. But unlike you and me, they're very unimaginative shoppers. They didn't say, oh, let's go and have a party, and they didn't say, let's go and buy a load of plant and equipment to have bigger industries in our country. In each case, they said, what we'll do is we'll buy up the state debt in our particular country. So the Federal Reserve Board was buying up American Treasury bonds, and the Bank of England was buying up UK government bonds, gilts, and the European Central Bank was buying up German government bonds and Spanish government bonds, and so forth. And their thinking was that if we buy these bonds off the savers that own them, they're probably owned by pension funds, by your insurance companies or whatever, two things will happen. One, we drive the price of the bond up, and as the price of a bond goes up, the interest rate you get on it falls, because the amount of income paid all the time is constant. So if the value of the thing goes up, the interest rate on it is clearly falling. And the second thing that happens is that the person who had saved the money and had invested it very prudently in a government bond has the money to spend, and they will go and do the spending. And they tended to go and spend it on different types of investment. They didn't tend to go on a round-the-world cruise or whatever. They said, well, it's still my pension money. So they tended to buy shares, so they were prepared to take more risk. They were prepared to put up money for companies to go and do things, and accepted they had to take more risk to get a return on their savings, or they went off and bought buy-to-let properties in the UK. And that worked for a bit until the Chancellor decided to tax it very heavily in 2016, when it made it rather more difficult, or other kinds of asset that they thought were appropriate for their investment. And this release of all this money, these billions that America and Europe and the UK released to buy up savings instruments, has powered this amazing bull market. So since the second quarter of 2009, with a few quarters or years when things didn't work out quite so well, we've had a phenomenal surge, particularly in the prices of government bonds, because those were the things that were being bought very intensively by the state itself, but also the knock-on effects. We've had a big surge in the price of shares and a big surge in the price of quite a lot of properties as people have deployed the money in that way, which is exactly what the central banks and the governments wanted you to do, because they wanted to create more confidence, they wanted investors to take more risk, and they decided that injecting all this money was the way to do it. And it was better than doing nothing. It has helped. Don't think it was as good as if they'd actually sorted out the commercial banks quickly and put the money into them to carry out their business in the usual way, but it was a good second choice, and it did mean that there's quite a lot more money in circulation, and eventually some of that money percolates through from just being money that chases assets to money that actually does some good in employing people. The share money becomes an investment by a company, and then somebody has to go and build a plant, whatever it is, so you get a response on the ground, and more employment is created and more activity takes place. So the world background now is, as far as we at Charles Stanley are concerned, a pretty good one still for those who want and are getting jobs, and for those of you who've got money to save, and that if you take a bit of risk, if you can take a bit of risk, it should be quite good conditions to reward that risk reasonably well. This is not a very contentious thing I'm saying. A lot of our competitors would say something similar about the economic outlook. I think we all tend to agree that this year the world economy is going to grow a bit over 3%, not fast by pre-crash standards, but pretty good, because it's a very big thing now, the world economy. And that within that, we're going to see the continuing pattern that the rich West doesn't grow as quickly as the emerging market countries that are trying to catch up. So we're going to see India growing around 7%. We're going to see China growing 6.5%, or maybe a little bit more. It was 6.8 on the last figures we've seen, but comfortable with 6.5 for this year as a whole. We're going to see the emerging markets as a whole growing more than 5%. And we're going to see the advanced countries growing somewhere around 2%. We're more optimistic about the United States of America than we are about most of the other advanced countries in terms of economic growth. Now, I'm not a Trump advocate, I'm certainly not a Trump voter, because I'm not an American. Mr. Trump does say some things that I don't really agree with, but it's my job as an analyst not to have a political prejudice, not to take a political view. I'm here to try and work out what is going to happen next, and what then the consequences of that are going to be for your investments and the investments of Charles Stanley's clients. And I did conclude very early on two things. I concluded that I thought Mr. Trump had a very good chance of getting the Republican nomination and going on to win the presidency. And then when he won the presidency, I concluded that he was broadly going to be very good news for the American economy and the American stock market. And so far I've had the better of those two arguments. The proof of the former is that in those early days when he was trying to fight for the Republican candidacy, I rang up the FT, because I write a monthly column for them on investment matters, and I said I'd like to write an additional article. I'd like to put my tin hat on and write an article saying, you know what, Mr. Trump could actually go all the way. And instead of them rubbishing me, as I thought they would, my editor said, oh, that's very helpful, because our senior editor came in this morning and said there's an outside danger Mr. Trump can go and become president. And our newspaper's never written anything decent or sensible about him. Maybe we should do so. So I wrote the first article in the FT saying this man could win, and this is what his economic consequences might be. Why has he been so good for stock markets so far? Well, very simple, conventional reason, and that is that Trump is reflating the American economy. He's trying to inject a lot more money and life into the American economy. What he had that other Republican wannabe candidates didn't have was he did have a message for a lot of blue-collar, possibly former Democrat voters in parts of America that were down on their luck, where their industries were aging or declining, and said, no, I'm going to look after you, men and women. I think you've got a set of issues, and I think I can make a difference to your part of the world and make your industry work better. So he he managed to win bits of the Rust Belt, as it's rather uncharmingly called, which Clinton would have regarded as her natural birthright to retain. And he's now trying to deliver for those people. And one of the remarkable things about Trump as a politician is that a lot of people thought he just said a lot of things for effect when he was trying to be president, but I think he actually does want to deliver those things, and I think he actually believes them. And so some of the things you might not like, but shock horror news, here is a politician who said what he's going to do, and he's actually going to try and do it. And we've had the first year in office where he appointed quite a lot of conventional advisors, and they were saying to him in certain cases, you can't do this, or you have to tone it down, or you have to moderate it. And sometimes he went along with that. And I think they went too far, because there was a type of briefing which crossed the Atlantic in our press as well as in their press, and you probably read it, where it said, you know, don't worry, Mr. Trump will go on saying difficult or extraordinary things in his tweets. He'll get up in the morning and talk to his electors in the Rust Belt, but he's not really running the country. And they invented this idea that there was a series of grown-ups. Did you see that comment? And that these grown-ups had all the important places other than the president in the administration, and so the Secretary of State would be very grown-up about foreign policy, and the Treasury Secretary would be very, very grown-up about economic policy, and the Trade Secretary would be very grown-up about trade policy, and so you could sleep easy in your beds. I think Trump got fed up with this. He's clearly no fool. He took on the whole Republican establishment and won when they didn't think he had a prayer. And so one day he decided to turn it into a sort of reality TV show and start firing these people. And we had plenty of firings. And he's now appointed a very different set of advisors, and some of them are much more in tune with what he was saying before the election. And I think the thing that made the big difference was having had a first year when it was quite conventional, apart from the tweets, and not a lot happened. He realized he needed to make a battle, and he decided to dig in over tax cuts. And he had to rely entirely upon fellow Republicans who were elected to the Senate and the House of Representatives, because they have the legislative power to decide on tax. And after some comings and goings, they actually got behind a version of his plan. Some of them had their own plans, and why not? And they eventually landed a really big, radical tax overhaul. And this tax overhaul slashes the rate of corporation tax that companies have to pay, offers a special promotional rate because a lot of American corporations with big overseas interests had decided that the then rate of corporation tax was unacceptable. So instead of remitting the profits to America and spending them in America, having paid tax on them, they put them into other centers around the world, parked them offshore and wouldn't pay tax. And so he's offered a discount rate to get the money to go back into America. And then he offered pretty good tax cuts for all income levels on personal income tax. So that will release quite a lot of spending power. And the Democrat critique was mainly that he was helping the rich, because obviously if you give income tax cuts, the people with most income get the most cash benefit out of it, because all income tax systems are geared to protect those on the lowest income, so you can't offer them such a big tax cut. And clearly his tax cuts offered a lot of tax reduction for the very large corporations. But then something very interesting happened, and the large corporations came out and made very supportive comments about what they were going to do. And they said, well, now we've got these tax cuts, yes, we're going to bring a lot more of our money back to America. And yes, we're going to spend quite a bit of that money on investing in America rather than it being invested abroad or not invested in any real assets at all. And even more interesting was quite a lot of them said, we do think our lower paid staff aren't paid very much, and they haven't had a bonus for a long time because real wages have been level or falling in America as they have been in Europe as well. And they started giving people pay awards. And so it was very positive. And so a lot of those Democrat voters who'd become Republican voters were saying, yeah, that's what I voted for. This is really helpful. I don't mind the rich bosses and the rich company getting richer if I'm going to share in the party. And so that started to work. And I think that gave him the confidence. And so then he pressed ahead as well with the second big part of his package, which was to make it easier to exploit oil and gas in America, because Obama had been pretty restrictive on pipelines and drilling and the actions generally of oil and gas companies. And Trump said, we've got a whole load of oil and gas reserves out there which we haven't been tapping into properly. We have the technology to do it. Sometimes it needs fracking, sometimes it doesn't need that, just conventional drilling, but you need the drilling permits and you need the pipes to take the product to market. So he started licensing all of that. And it's growing extremely well. And this year, America will overtake Saudi Arabia and will become the world's second largest oil producer. And next year, maybe she'll overtake Russia and become the world's biggest producer. And America has added over 1 million barrels a day to her output, a 10% gain. And in a world where you're talking about 100 million barrel a day total, that's a significant measurable amount which will have an impact on the oil price and is certainly very beneficial to the United States of America in terms of revenues. More importantly, tapping into the gas reserves, he's going to get access to a lot more cheap gas, and you need lots of cheap gas if you wish to have a successful industrial strategy. Number one thing I'd want for a successful industrial strategy is lots of cheap energy and cheap feedstock. Gas is a feedstock for the chemical industry, and then you also need cheap gas if you want to run kilns to make ceramic tiles or bricks or glass or whatever it is. All these things need huge quantities of energy, so plentiful, available, cheap energy, absolutely crucial, and America will price herself back in to more of that kind of activity as a result of the energy revolution Trump is trying to unleash. Also a bit of deregulation for the banks, because he does think the Fed, like the European authorities, had got too strict on the banks in reaction to the crisis, so he's easing that a bit, particularly the smaller challenger banks, so that there will be a bit more credit around for people in America who want to venture. And all that is extremely bullish. And it was that, the markets waking up to what Trump was doing, that powered that remarkably good performance. I think it was up by about a quarter in the first year of Trump's presidency. But then we get to January the 23rd this year. And we just had 3 weeks of amazing upward surges in markets, something which some wordsmith decided to call the melt up. And just to the point where they commissioned that phrase, it was over, of course, as so often happens. And suddenly the markets came off and people were not happy. So what happened? Well, again, it was about Trump. And I'm spending a lot of time talking about Trump because I really do believe Trump is the most important single influence on world markets at the moment. What Trump does, whether it be in Korea or in the Middle East, or more particularly in the oil market or in the trade system, is what the markets are hanging on and are going to move on. And the reason I spend so long on America is that the total aggregate quoted wealth, the amount that all the quoted shares are worth in America, is still 52% of the world total. So the American stock exchange isn't just the biggest, it is more than half of the total world quoted stock exchange wealth is in America, where each of the European markets are less than 10% each. And so yeah, you look to America to provide the leadership in world markets, and so often London and Frankfurt and so forth follow from the kind of lead and the kind of movements you're seeing in the United States of America. So what happened was that Trump had got rid of his grown-up advisors who told him that he wasn't allowed to disrupt the perfect international world trade system which he'd inherited. And Trump had always said, campaigning Trump, had said to those people whose steel works was closing or whose aluminium works was going on to short time or couldn't sell enough aluminium, he said, you're the victims of unfair trading. And he particularly picked on 2 countries as the worst unfair traders. Biggest was China, and the second biggest was Germany. And Trump chose those from a very good database, because if you look at the current state of the world, America has a balance of payments deficit of getting on for $600 billion a year, massive deficit. They import so much more than they export, whereas China has a surplus of 400 billion or so, and Germany has a surplus of 200 billion or so. Don't quote me on the numbers, but it's that sort of order of magnitude. And so it is the German and Chinese surplus and the American deficit which are very prominent. There are lots of other countries and lots of other surpluses and deficits, so it's a bit more complicated than that, but Trump was right that that's the bare bones outline of the thing. China is the exporter of last resort, and America is the importer of last resort. That's how it works. And the UK is one of those countries on the American side. We tend to be a very generous importer, and so we have more of America's problem than Germany's problem. So what Trump said was that he was going to challenge the World Trade Organization rules. And in his first year, his rather cautious team picked a fight on 2 or 3 products where they thought they were being dumped by other competitors around the world, and there is a procedure under World Trade rules that you can present a case that somebody is dumping product, they're undercutting prices unreasonably, they're subsidizing the industry, whatever it may be, and you can impose a tariff to deal with your perceived damage from the lower prices so that the products don't circulate in your market anymore on the cheap. And they chose solar panels as one of the ones in the United States of America where they were pretty sure there was foreign dumping. And then you have to go through a procedure, because if the other guys don't agree and don't put their prices up, then there's a procedure and the WTO adjudicates as to whether it was a fair cop or not. But Trump got fed up with this because he said actually it's a much bigger problem than this with those huge deficits and surpluses. So what he said was, I've got direct powers under American legislation which says that if the national interest of America, our strategic interest, is damaged by dumping or unfair trading or whatever, we can just unilaterally do what we like to try and sort it out. And he picked on steel and aluminium, and he was quite sure that foreign countries were undercutting Americans unreasonably and stopping them making steel and aluminium at home. And he said, well, America needs a big weapons industry because it needs to arm itself to make itself safe, and so we need to be able to produce our own steel and aluminium because they are still part of the sinews of war. There was a big intake of breath around the world, and people were not very happy about it. And then, of course, they started to negotiate, which is exactly what Trump thought they would do. So Canada, for example, and Mexico, who were big exporters of steel to America, said, well, that can't really apply to us. We're the good guys. We're in the North American Free Trade Association with you. And Trump said, well, I'll tell you what, if you sit down and do a fairer deal generally under NAFTA, because he doesn't think it's a very fair deal, I'll let you off those tariffs for the time being, but you've got to sit down at the table. Give me a better deal on NAFTA. Chinese actually don't export very much steel direct to America, although they do account for about half the world's steel production, and it is the case that it's excess capacity in China that is the main reason steel prices are as weak as they are across the world. And he did cite the Chinese overcapacity in his statement of case about the need for steel tariffs. But before that could really get sorted out, Trump upped the ante on China, and he received a report he commissioned some time ago about China's approach to intellectual property. And Trump said, China is an intellectual property thief and cheat. Doesn't mince his words. He may have used less polite words than I've just given you now. I'm trying to make it suitable for a family audience. But he was quite sure that they were cheating on intellectual property. And it's very interesting, talking to businesses in this country, let alone in America on this, instead of being horrified and shocked about these allegations, they nearly always come up to me afterwards and say, you know what, that happened to us. And of course, China has done it in all sorts of ways. Sometimes they just spy on people, they buy their product, they reverse engineer it, they hack into the internet sites they need to hack into or whatever. But quite often what they do, because these are usually large international companies that have the technology, is they invite them into China to be an investor in China, but they won't allow them to 100% own what they're doing in China. They make them have joint venture partners, and the joint venture partner then insists on seeing how the technology works as part of the joint venture, and then of course the technology is out there. And sometimes companies report to me that it's not just a question of family resemblance or using an idea that the West has had. Sometimes the Chinese will set up a factory and make the product that is not only identical but have the Western brand name on it as well, because that obviously adds to its perceived value, and that is clearly cheating on a grand and heroic scale. So Trump has challenged them on this, and the Chinese have been remarkably statesmanlike about all this. And so instead of getting into a tantrum, they've said on intellectual property, well, we want to uphold the international system. That came as an interesting observation from them. And they said, we do have a sort of quango already under government control. Maybe it's not enforcing it properly, so we're going to go in for more enforcement. So Trump now is going to send people to China and explore that and other things. So they're in negotiation. Will the Chinese come up with a package on intellectual property? He also wants a package on market opening. And this is true for both China and Germany, although he's concentrating on China at the moment. Let's take the issue of cars. As Trump himself tweeted, if an American tries to export a car to China, there is a 25% tariff on the vehicle going into China, which is a pretty good killer. Whereas when China exports a vehicle to America, as she may do in increasing numbers quite soon, now she's got more competitive product, there's a 2.5% tariff. So Trump tweeted out these bare figures and just said, call that fair trade, and went on with richer language, as you might imagine. And in the case of Germany, stroke EU, if America tries to sell a car to a German in Germany, it attracts a 10% tariff, whereas Germany sells a lot of cars into America and they only pay a 2.5% tariff. So again, Trump tweets about what he calls the floods of German cars going into America, and he thinks it's very unfair that you have these asymmetric tariffs buttressing the German industry and hindering the American industry. So markets got in understandable worry. I was in an understandable worry because if Trump pushed too far on all this and the other sides reacted without helpful improvements but got very aggressive and started imposing their own tariffs on America and so forth, that would be very negative. And it would threaten in due course lower output, less trade, and therefore would be bad for economic growth and definitely bad for stock markets. Stock markets would be hit first, and then the economies would definitely be slowed by this process. So we then have to come to a judgment about whether this is serious and how far it might go. And we've concluded that it certainly explains why we've had a bit of a hit, and we could have some more bad days ahead if Trump gets very aggressive in the language, as he may do from time to time, to make his point. But we suspect that the man who wrote or signed off on somebody else writing a book called The Art of the Deal does want to do a series of deals. He wants to do bilateral deals with China and the EU and so forth. He doesn't like multilateral deals, but he would rather settle, but he's going to give them a run for their money before he accepts a settlement. So we think we can get away with it. And as to timing on all this, we may have several more months left of down markets as well as up markets on trade news, because I suspect what's in the president's mind, because he seems to be pretty party political as well as political, is that he's got midterm elections to fight come the late autumn in America, and it would be really great to have some kind of presented package or agreement, at least with one, if not two or three of these major trading partners, to say to the electors, there you are, I haven't let you down. I told you the trade was rotten. I've now got a win. I've got improved terms of trade, which I can now offer to the American people. So I think that's the way it's going to go. So It's going to be a lot of noise in the system. It will affect timing of purchasing, but I don't think it affects the overall case, if we're right, that the end result of all this will be a bit freer trade around the world, having been achieved in unconventional ways, shall we say, by a president who wishes to wave a big stick and make progress. And you can see that, the Trump style of negotiating, if you look at the news we're enjoying at the moment, where we saw those very, very touching and encouraging pictures of the leaders of the two Koreas actually meeting and talking about easing their tensions and having more trade across their very damaged and aggressive border, and maybe going on to talk about the disposition of both American and North Korean weapons, which have been escalating in recent months. And there, Trump broke the democratic approach and the more general Republican approach prior to him of doing it softly through diplomatic language, and Trump decided that if he issued the odd threat to what he in those days saw as a small rogue state, maybe it would get some movement, and he will now claim that that's why we've got movement, and that's why the leader of North Korea announced the cancellation of all atomic weapons tests and the closure of a facility. Others will say, oh, it was happening because of South Korean diplomacy and that Trump wasn't relevant. But Trump will claim some credit, and he will capture a lot of the news headlines because he is clearly very big news, and I think definitely Trump had something to do with what is now happening in Korea, and he will certainly draw from that the conclusion that if you go in there and talk tough, you may get some movement, and that's what he's trying to do on the trade front. We still like American investment. The American stock market is dearer than the European or Japanese stock markets. If you look at the relationship between share prices on average and how much earnings the companies are coming up with and how much dividend they pay, it is dearer. And the reason we like it, apart from the Trump reflation creating faster growth, is the technology. And the really big thing going on in the world at the moment is this enormously crucial digital revolution. And it is about American corporations, unfortunately. On our side of the Atlantic, we simply haven't created the really large corporations that can do what Facebook do and what Google does and what Apple does and so forth. And so our consumers are very dependent on these great American success stories, just as American consumers are. The only rivals in the world are in what is still a fairly closed economy in China, where China has adopted the digital revolution. I don't know how she came by all the technology, but she now has the capacity to innovate. It's not all copied by any means. Some of the new apps being deployed in China are Chinese apps. And there you've got the Tencents and the Alibabas, colossal corporations on a similar scale to Facebook and Netflix in America, serving that 1.3 billion people, because the American corporations can't really get in because there are still lots of protections. And of course, a much more managed internet in China, where they, from day one, had a lot of censorship. The West is now arguing amongst itself over how much censorship it needs to have on the web, because the original pioneers just thought they were offering freedom, free expression, free exchange, but they've now accepted that promoting terrorism is not an acceptable thing to do on the web, and they've accepted that use by criminal gangs to promote criminal activity is not acceptable, and we're now having this more difficult debate just beginning over Facebook. Free service model, nothing is free. So why is Facebook free? Well, it's because they can send ads to you. I thought people understood that, but there is some debate now. And the debate seems to be that if you get too clever at targeting the ads, maybe that's an intrusion in privacy and liberty. I'm not expressing a view on that because it's a political issue, but we have to weigh that up as investors. How far would it go in trying to find that right balance so that these very powerful corporations are not helping the bad guys, that the individual is sufficiently protected, but that the individual I think also has to accept that if they want a free service, then you're going to get adverts because that's the only way the thing can work. We all accepted in the days when families sat around the TV set that in return for getting good programs from ITV that you didn't pay for, every 15 minutes or so they had the right to tell you that you weren't using the right washing powder or that you needed a different drink to get you to sleep at night. And you either accepted that or you went out and made a cup of tea while they were telling you that. And it's the same with Facebook and internet. You've either got to accept it. Indeed, some people will like it because I don't mind targeted ads. I'd far rather see an ad that was relevant to me than an ad that wasn't relevant to me. But others won't like it, so they'll have to find their own way of getting rid of it for themselves. So the technology is a big driver of America, and it's a big driver of the global bull market, and I think it's something which is still there. But again, as from February, there are some doubts, and the doubts all relate to when do the tax authorities catch up with these corporations and make them pay a higher tax rate, and do the regulators go too far and get to the point where they damage the model. They're clearly going to increase the cost base of these companies because if you're going to regulate the content more, then you've got to have more staff and employ more people. Hasn't left me time to give you any insight into Europe. Happy to go there if you want to go to Europe in your questions, but putting it all together, what are we saying for those portfolios that can take some risk? What are we doing in those? We're saying we prefer shares to bonds because we think interest rates are now going up a bit, and so bonds won't be a great investment in the way they were from 2009. We therefore prefer shares, and within the shares you need to be very conscious that the new economy is ripping apart the old economy. And so for every big turnover gain that Amazon gets, because you're shopping more with Amazon, you should expect another store chain to close because you're not going to be spending a pound in both places. You're either spending it with Amazon or you're spending it with the shops. And people on both sides of the Atlantic are saying, you know what, I'd far rather spend it with Amazon. And so there's this massive internet market share gain, so you're going to see traditional retailers having to adapt, or quite a lot of them going under. And in America, a lot of them are going under, a bit further advanced in some ways, and that is the pattern. So in share investing, you'll be very conscious of this wave of economic change, which gives you huge opportunities to make money. But if you stick with old traditional companies and brands for too long, and their managements aren't much good, you could lose all your money. On that happy note, I will take your questions.
You mentioned some of America a great deal. It's rare on it, but you didn't mention anything about the FX roller coaster. What do you see the risks if somebody's investing in America, which way the FX might affect us in that? Because it's changed so much in the last 12 months even.
Yes, I'm asked, what about the danger of currency movements when you're investing in overseas? And it's quite right, there is such a danger. You can always protect yourself. If you invest through index tracking exchange traded funds, just buy the whole portfolio of shares that there is in that stock market. You can also buy it protected into sterling, so you don't have to take the risk of the dollar or the yen or whatever it is if you're buying American or Japanese shares, and the cost of that cover to protect you from any upward movement in the pound is very small. But conversely, if the pound goes the other way, you don't get the winnings. On the whole, in recent years, the pound has been trending down, both before and after the Brexit vote. But in the last year, because the Bank of England decided to tighten policy, it put up interest rates, it withdrew quite a lot of credit, it took away all the special facilities for the commercial banks, it cut car loans by offering much stricter advice on car loans. So the Bank of England decided it wanted to slow the economy and take quite a lot of credit out. And then sure enough, the pound went up. Because if you have less credit and fewer pounds around, then the value, if all things are equal, tends to go up. So the pound has risen quite a bit against the dollar and even a bit against the euro in recent months. So there is exchange risk there. If you don't like that, then buy an investment that protects you against it, because that is now freely available. Or sometimes with your investment advisor you might want to take exchange risks, because if it was a time when you thought the pound was about to go down, then it's even better to have the foreign investment because it will give you a double win. If you're right, you'll get a gain on the currency as well as the shares. We're not particularly bearish about the pound at the moment.
Do we need a Trump-like figure to help with our Brexit?
I think that's a political question, and I'm here with a different hat on. Yeah.
Yes, it's a domestic question, really, John. Our pension companies have a greater deficit these days over their assets. How do you see that panning out?
Well, the main reason the pension funds have a very large stated deficit is the way that they are valued. And the way they are valued is very dependent upon the interest rate you get on a government bond. And because the interest rate on a government bond is very low at the moment, compared with history, the liabilities are apparently very expensive to finance because you would need to buy an awful lot of government bonds at the low interest rate that they provide in order to pay all the pensions. So if we're right that interest rates over the next few years trend upwards, and they're clearly going to go up quite a bit in the United States of America, and you'd expect some of that to follow through to Europe, then some of it will be self-resolving, because as the interest rate rises, so the deficit of the pension fund goes down without anything else happening, because it suddenly is a lot cheaper to buy the bonds to pay all the future pensions. If that doesn't happen, and if we carry on with ultra-low bond interest rates for a long time, then, as you know, the pension funds have to work away at narrowing the gap. They don't have to get rid of the gap in one go. They've usually given something like 10 years to work their way out of it. How can they work their way out of it? Well, they can get better gains on their investments. So if they are successful investors, they'll get some credit from building up the pot of money they've got by getting better returns. Or they have to look at future liabilities, and they have to start saying, well, there won't be the same increases in pension that you would like to see, and they have to negotiate that with the trustees and with the membership of the scheme. And this sometimes involves difficult choices, as we've seen. The pension regulator, I think, is now being very realistic, because I think they fully understand that if you ask a company with a pension fund with a big deficit to put too much money into the pension fund early on to deal with the deficit, you may weaken the company. And the best protection of your pension being paid in retirement is that you have a pension fund backed by a solvent, successful company, because then as need arises, the company can tip a bit more in. And so I think they are weighing this up. If you ask too much, you weaken the company, and the worst of all possible worlds for someone with a company pension scheme is if the company goes bust, because then there will be minimum provision made through the bankruptcy arrangements, and you've lost access to the flourishing company. And under the previous Chancellor, new guidance was issued to say that if a company could make a good case that they could spend the investment money more productively in the company than putting it into the pension fund, then maybe that was the better option, because then you'd have a stronger company generating more profit so that it stood behind the pension fund.
You mentioned America increasing potential oil production. Is that likely to result in more oil sloshing around in the markets, or will it merely be an offset for a reduction of productivity from the other OPEC producing countries? Are we likely to see more of a surplus of oil available and therefore a drop in price, or is it just going to be an offset arrangement and the status quo will remain?
Very good question. OPEC have tried to offset it by curbing their production. I don't think they can curb it more, and they may carry on with their current production curves. America, of course, is not a member of OPEC. America will produce what America wants to produce and doesn't think it should be cartelized and controlled. And we've had, for some time, a surplus of oil compared with the easily available demand, and so oil prices have tended to be weaker. They used to be at $110, $115 a barrel. They slumped to very low levels, and then they traded around 50, 60. What do we think is going to happen next? Well, we think there will be an increase in world supply, because we don't think the extra American production will be offset by further OPEC cuts. We assume that OPEC will keep to its cuts for a bit longer, because otherwise you get an even bigger increase in supply. And it looks as if Russia, not formally a member of OPEC, is working with OPEC, so we don't expect a big increase in Russian production. But what is also happening is demand is picking up because you've got world growth. So we think the two lines are getting closer and closer together, and so the position is set for oil prices to be at this level or a little bit higher because demand is catching up with supply.
Will the increase in electric cars have a big impact on this production, supply and demand of oil?
Yes, but not yet, I think. Electric cars are not very popular at the moment, partly because they're still very expensive, and partly because they still need to improve the performance and range and access to charging points and so on and so forth. And one of the problems of launching a new power source and technology for something as successful as a motor vehicle is that people are used to very easy use and plenty of access and capacity. So you don't worry about where you're going to get your next fill of petrol or diesel from, because we've got filling stations all over the place, and some of them are open 24 hours, and your sat-nav will tell you where to go. We haven't got to that point yet with electric charging points. Now, it shouldn't be difficult, because theoretically we've all got an electric charging point called a home, which is wired to the national grid. But there have to be charging points out and about for when you're doing journeys, and they also need to crack the problem of how long it takes to recharge if you're going on a long journey and you discover you've run the thing down too much. So all these things are being thought through. I think I'm fascinated by change in the car market, because the car has been an extraordinarily successful technology for about 100 years or so. But the model hasn't changed. Of course, they've got more complex and faster and more comfortable and got radios in and all these sort of things, which they didn't have when they started off. But it's still recognizably the same kind of product marketed in the same way, and you tend to buy one, or you buy it with a loan package these days, but you own it. And the bigger challenge, I think, to the motor industry than whether they're going to eventually flip from lots of petrol and diesel to electric is how people are going to buy and own cars, and whether they're going to buy and own cars. Because if you go over to something more like the Uber rental model, you don't need nearly so many cars. And I did a sum the other day, I'm just trying to remember the exact numbers, but very roughly, the average car in Britain is only used 11 days of the year if you added up all the use and made it a continuous use. And so for 350 odd days of the year, your car and my car is parked somewhere. And just think about it, you know, how many hours are you going to use it today, and will you use it tomorrow, and so forth. And so it's mainly parked. And so we have to buy far more cars than we actually need, and then we have to find places to park them, which takes up a lot of road space, as well as if you're suitably rich, your own garage space or whatever. And so it's all a big complication. If people went over to the idea that they just have a car when they need one, then there'd be a huge reduction in the number of cars you needed. Maybe you'd have a reduction of 3/4 or something in the number of cars you actually needed if you used them much more continuously and just cooled them up. And the younger generation, more than the rest of us, I think, are interested in this idea. They're not so into ownership. And so maybe if I live in a city and I don't really need a car most of the time, but I need a car to drive out to see mum in the suburbs or something, I just want to call it up and rent it. And the bridge is coming from challenges. I was reading this week. A Chinese company has come to Europe, has done a joint venture with Volvo. They've produced an SUV, looks very similar to all the Western European SUVs that are on the market. It's going to be a very comparable kind of vehicle. I don't know whether it's better or worse or the same, but it's going to be in the market as a perfectly feasible option to buy as an SUV. But it also has great innovation in financing, and they're going to offer two new options. One is you can monthly rent it, and so you can take it on as your car, and if you wanted to run it for 36 months, you just renew it monthly. It's still yours. But if after 1 month or 2 months you're fed up with it, or you've seen a better one, you can just cancel, and they take it away, and you've got your choice back, and you haven't had to make that capital commitment and that loan commitment that you make with the the 3-year loan package or whatever people tend to do who buy it on debt. And the other option they've got, and I haven't seen the details, so don't know how it works, I want to find them out, is they've got some kind of car sharing element to it. So presumably you're the main renter and you've got your car, but when you're not using it, they can call it off and do something else with it, and that presumably cuts the cost. So they're playing around with these ideas, and these could be even more revolutionary for the car market than the switch of traction to electricity. And as to the sort of impact on oil and gas, because it takes, on most people's estimates, quite a long time to switch everybody over, and because the emerging market world is still growing and needing a lot more oil and gas for all sorts of other reasons, they don't think that oil demand and gas demand is suddenly going to fall off a cliff in the next decade. Long answer, but I got interested in that, I'm afraid.
I was thinking in particular of Tesla's development that's going on, and also Dyson's rapidly coming out with something.
Yeah, they're all trying, and you know, Tesla has an enormously expensive share price, but is really struggling to get the production volumes and quality they need to sustain the interest. And once they've got a clear product at an affordable price, rather than it being at the moment a rich man or woman's option, then they're going to need a huge step change in production volumes. And meanwhile, one assumes the people who know how to do big production volumes will adapt to the new technology. But it does take time, and I have, in a previous job, been involved in the automotive industry, in industrial production. And these things do take so long for the conventional companies because they're so desperate not to make a mistake. They are producing an extremely complicated product that can kill people. And so they are very conscious, rightly so, of their moral responsibilities to get it right. And also for business reasons, that if you put a car out there and a $10 part in that car starts failing regularly and messing up your customers, you've got a very expensive set of recalls on your hand just for this tiddly part that has gone wrong, which wasn't properly supervised or properly designed. So they take years and years over design and testing, and before a component supplier can get on a program, there has to be a long process to make sure that the thing does meet the spec's right, and it's going to work. And so it takes a long time to change a car. And so when you then have challengers coming into the market saying, you're all old hat, we're going to change everything, you've got this disjunction where the challengers don't have the volume and the capability to churn it out to the standards required yet, and you've got the companies they're challenging saying, this is rushing us, we don't do fundamental radical change like that, we do evolutionary change. And when I was involved in the motor industry, I mean, I was wanting to speed up our rate of change for good reasons. So I went to see how they do it in Formula One. And that is remarkable, but of course it's about resource. And so they throw huge sums of money and very high levels of technical expertise, very highly motivated into these vehicles. So whereas it may take 5 years for a conventional car company to design and test a new model, the Formula One car next year may be very, very different, almost a different vehicle from the Formula One car this year, because they've accelerated all those processes. But it does require so much money and technology, it's quite difficult for the traditional car manufacturers to match that.
You said earlier that the changes in the US might lead to freer trade around the world. So what are the implications of that for us post-Brexit?
Well, I mean, if that is right, it's marginally helpful. And the context of all this, I think, is that free trade agreements are useful, and they can make marginal improvements in the volume of trade between the parties signing them. But now we have the World Trade Organization rules and system well in place, the successors to successive rounds of the GATT, lowering tariffs on industrial products in particular. The bulk of world trade is actually guaranteed by the World Trade Organization system, of which we in the EU and the United States of America and China are all members. And there are strict limits on how much tariff you can impose. There are large areas that are tariff-free, like services. And now, as from March 2017, there is a long and fairly complex regulation of the WTO called the Facilitation of Trade Agreement, which everybody signed up to, which deals with a lot of the non-tariff barriers and gives very strong guidance or requirements on how goods should move across frontiers. So I think the system works pretty well now, and it has been progressively liberalised over the years. And free trade agreements are useful additions on top, but they're not usually major game changers. They would be more with the emerging world, because under the WTO system, the emerging world is allowed various exemptions from the overall system.
Great. Right, well, can everyone just give John another round of applause?